Welcome to the Treasury Update podcast presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. On this final segment of Strategic Treasurer's Fintech Analyst Report series, special host Meredith Zonsius joins Managing Partner Craig Jeffery to discuss key takeaways from the Supply Chain Finance and Cash Conversion Cycle Solutions report. Topics of discussion center around factors that affect and drive supply chain finance, today's challenges and solutions, leading practices, and more. Listen into the discussion and enjoy the entire series. Welcome back to the podcast, Craig.
It's good to be here, Meredith.
Today we'll cover our last segment, wrapping up the three-part podcast series on Strategic Treasurer's Fintech Analyst reports. For those just tuning in to the series, these newly released reports offer insights into the latest developments, trends, and solutions around new Treasury and finance technologies. As a quick recap, we covered Treasury and risk management systems on the first segment and Treasury aggregators on the second segment. On this final segment, we'll discuss supply chain finance and cash conversion solutions. So let's dive right in, Craig. Can you give us an overview of the supply chain finance and cash conversion solutions analyst reports? What was the purpose of these reports and why are they such a great go-to source for treasurers?
Yeah, Meredith, these analyst reports are, we think, are vital to the space because so many corporations are selecting and implementing technology. And this is a very significant activity. They don't do it much. There's a significant upside to doing it properly, and there's a downside to missing out on pitfalls or understanding the space properly. So people need information to understand the space properly and effectively. And since Treasury is very specialized, some of these analyst reports are very focused on Treasury versus broader finance or accounting or purely supply chain, for example. And the need to know this information is driven by corporate buyers in the Treasury area. But it's also important for fintech investors. We find a lot of fintech investors use the report, but also technology firms that are either in the exact space or in an adjacent area to better understand what's going on or to gather multiple views of the space, market, developments, and issues. And so this is a way of sharing that information broadly with the market. So we have 3 analyst reports we've been running for multiple years. Some have gone back, I think, 7 years. And this next year, we may add a 4th to the mix.
Craig, to get a better understanding of supply chain finance and the cash conversion cycle, can you define the terms and explain the components?
Sure, Meredith. On page 7 of the report, there's a definition of cash conversion cycle, supply chain, and working capital, which is a way to understand it, more definitively. But let me give a crack at it now. So the cash conversion cycle is it's referred to as a cycle because you start with cash moves into the business operations, and then you pull it out. So think of it as you buy inventory, so you have a payable. You've invested that cash into the inventory that you have, and then it becomes a receivable. And then when you close out the receivable by collecting cash, you've pulled it out. So this is a measurement of efficiency, of how an organization can move their activity through this cycle efficiently. How quickly can you convert cash to inventory, materials, receivables, and pull it back out? So that's one. So think of inventory, receivables, and payables as a component. The processes around those all impact the cash conversion cycle. Supply chain finance, we like to go with the definition that the Euro Banking Association came up with. I think it's clean, and it's an easier way to describe it. It's the use of financial instruments, practices, and technologies to optimize the management of the working capital and liquidity tied up in supply chain processes for collaborating business partners. Now, that's a long definition, but it's the idea of how do we, use tech practices, financial instruments to extract more value out of the trade of business documents and the movement of financial value. So there's plenty of examples of it. So one example might be I have receivables, but I want to convert that to cash more quickly than those paying me want to do it. So maybe I get a financial intermediary or instrument that allows me to take cash and for offer some discount for what I would be receiving. And there's different ways to do that, from a supplier or a buyer perspective to not make it so exactly tied into when someone pays, I get paid. It introduces other parties to the mix and grants more flexibility on some traditional practices. Finally, working capital is a sub-definition of that, but there's two definitions, and I'll just talk through them briefly. One is the accounting definition or the banker definition, which is a measurement of do you have liquidity to meet your financial obligations as they come due. And so if you look at your balance sheet, it's current assets minus current liabilities. And the desire there is, of course, that the current assets would exceed current liabilities, seeing that a current asset might be cash or receivable. And since you can't pay with receivables directly, cash is important, and converting the receivables to cash is vital there. The other definition is related to the adjusted net working capital. And so that's accounts receivable plus inventory minus accounts payable is a measure of what cash is tied up in those three elements. So it dives in a little more narrowly from the current assets and current liabilities to look at what cash is tied up in something like receivables, or you've put too much in payables, or you're having a problem making collection. So those are some of the key definitions. I know there's other terms too, with types of supply chain financing, but that's at least a good start with definitions.
What are today's challenges, and how can a supply chain finance and cash conversion cycle solutions help?
Yeah, so the challenges are different depending on what role you're playing in an organization. And, if you're in payables or you're in the credit group or the cash application area or treasury, your priority around efficiency, liquidity, risk management, cost efficiency may be quite different in your particular silo or department. So when we think about today's challenges, they are all those things. How are we efficient? How do we have good control? How do we manage liquidity, support good risk management practices? Those are all some of today's challenges. No different than yesterday's challenges. Sometimes they're exacerbated by events like the liquidity demand at the beginning of the COVID crisis, et cetera. But both supply chain finance and the cash conversion cycle solution sets help across a range of these needs. Some touch on all of them, some focus on a particular area nicely. But I can give you a couple examples if that helps.
Yes, that would be great.
Okay, so let's start with capital, since I favor treasury much of the time. The idea of capital is that a supply chain finance solution might allow our company to hold on to funds that are in our payables instead of paying in 30 days or 45 days or whatever. I might be able to hold on to those funds longer without impairing our trading partners. They may want access to funds sooner, and maybe we need to pay in 60 days, or we want to pay in 60 days. They want to collect in 30 days or sooner. And so there's this tension of we want to extend and they want to shorten. And if we extend, they lose and we win. And if, they make us pay sooner, they win and we lose. And so it's this, a win-lose situation. But the idea that we might be able to pay later, we pay later, and they can collect sooner. And this is usually done with third-party money. That's one example of how we can help on the liquidity front. But it also helps on the visibility front too, because these tools allow you to know when you're getting paid, and knowing is substantially superior to estimating and forecasting. Yeah, another one is an SCF solution of sorts may allow us to use something like dynamic discounting. I know some people disagree with that's a supply chain financing mechanism, but it's a tool in the space. And so this allows us to offer a more continuous or linear method so that we can collect more funds early. The typical or the traditional discount method to encourage people to pay sooner might be 210 net 30. You get a 2% discount if you pay within 10 days, or you get no discount, but you have to pay within 30. So this means that some organizations may be, I want that discount and I have cash, I'm going to pay in 10 days. Others may have the desire to pay a little bit early, but they're waiting for other payments, or they can't get approval until 15 days. Well, once they've hit 15 days, they're not going to pay 15 days early and get no discount. They're going to wait to 30 days because they're good stewards of their resources. So something like dynamic discounting means, it might be 1 3/4 or 1.6% discount if I pay in 15 days. Well, I've got approval, I've got cash. That's worth it to me to pay earlier. And the result of that is that it provides more flexibility for those that want the discounts, and it provides greater coverage for those needing to take the discounts. And so that's just one method of expanding the reach. On the control and security front, I'll give an example there. There's lots of examples, Meredith, of course, but the cash conversion cycle solutions that organizations look at, they may have a very significant network, a network of vendors, for example. They keep the vendor information updated, all the banking data, how they want information, so it's efficient. And what this means, if you tap into this network, you're tapping into the power of the network in addition to the technology. And so this means your company doesn't have to maintain all of the banking information on an ongoing basis. You don't have to do this out-of-band verification every time they make a change to banking information, because you're leveraging this network of activity. The other factor of value in the cash conversion cycle is that you can leverage the network not just for future security, but if you come on board and you're trying to convert people to more electronic methods of trading, end-to-end electronic back and forth, not just the payment, but the payment exchange of information, is now your trading processes can become more completely digital more rapidly, because these other trading partners are already set up digitally, and you can immediately realize 20, 30, 40, 50% of your population to move to a more digital environment more quickly than trying to onboard everyone yourself. So those are a couple of the challenges in how SCF and CCC solutions help organizations in this way.
Let's talk a little bit about automation opportunities. If the overall goal of the cash conversion cycle is efficiency, where can technology help?
Yeah, so I think on the cash conversion cycle, with the overall goal being efficiency, that's probably the top goal. When you look at AP, AR, credit, they're oftentimes thinking efficiency is number one. But there's other elements about security and capital that matter to the organization, maybe not as much to AP and AR, but they certainly matter to treasury and to the overall organization to protect their assets. So how can technology help? There's a number of areas. So we think about end-to-end efficiency. Well, because there's tools that we can connect to that'll do different functions, scanning invoices, gathering data that's submitted electronically, providing a single file that'll post to our receivable system, we gain efficiency, and it allows us to spend far less time on the regular and the mundane and the systematic, and more time on those items that are thorny issues or require much more to resolve them. And so this allows us to get closer and closer to straight through processing. And because it's more digital, it has a lower error rate. And errors are another way of saying defects. Defects break a process. It gets people involved. There's additional touch points. And that's really horribly inefficient from a process standpoint, but it also has a ripple effect onto capital. Whenever you break a process and people are involved, there is worse information to know when payments are going to move to or from, and so nobody wins in those situations. Technology, helps that way, and helping us get more of an end-to-end process going, and they also help in the move to digital, which is a key factor in helping that as well. I already talked about the power of networks and gave examples of payments and payment information and security. The power of networks is how big are the networks, what you can do on the networks. And so this is a way of leveraging that as well. So the power of networks are part of the power of those that provide the cash conversion cycle solutions, the SCF solutions. The other area that how can technology help, and I won't get into this too much because I know we covered some items on technology in other spaces like TMS, et cetera. But leveraging machine learning within some of these tools is helping with forecasting. It's helping with quality control, detecting anomalies. And another aspect of detecting anomalies and monitoring what's standard and what's not helps with security and fraud management. And then the other area where technology can help is essentially all of these solutions are now delivered through the cloud. They're leveraging the power of growing networks and growing capabilities, which makes them investments that increase in value over time. We're not looking to see what has the most value and how long it takes for it to decline in value. We're looking at how much value is there now and how is that growing over time. So those are some of the areas technology can help in broader descriptive terms rather than specific areas.
Very good. What are the various factors in the landscape that affect and drive supply chain finance?
That's a good question. No, it's a good question. There's a lot there. I guess when I think about SCF, more so than the cash conversion cycle, the big factor or the environment, the background on this is the total access to capital. It's not a secret that larger firms typically have easier access to capital, less expensive access to capital than smaller firms. This is significant, and I think we all know that cash is king. It's far superior to receivables, for example. And SCF, supply chain finance, grants more companies access to this capital, or more access to the king, if you will. So a larger firm that opens up an SCF program invites their suppliers who typically are smaller. Now those suppliers have another line of access to capital that they may not have. And so that greater access to capital improves the entire trading ecosystem of these vendors. That's a significant issue. It's we don't have complete access to capital at the same levels across all size of companies. So this is a helpful way of democratizing capital in a way, because other partners are letting their balance sheet perhaps make a difference to their trading partners. The second factor that I wanted to mention with that, Meredith, is that there's this payment terms and payment processes are win-lose. I want to hold on to cash longer. I pay you 10 days later. I won. I got to use that capital 10 more days. I increased my liquidity on the back of your balance sheet and your costs. And so I paid later. You received later. I won and you lost. And so the win-lose of the historical trading relationship, can easily be truly translated into lose-lose. And the reason for that, as you can see, is there's regulation in different jurisdictions about when you have to pay, because there's some firms can keep extending payments and to the point of damaging or sometimes causing their trading partners to go under, but certainly harming them in a certain way. So there's some regulations there. The other factor is that this makes the cost of doing business more expensive for your trading partners, and they must eventually factor that into the costs that they have to you. Maybe not immediately, but certainly over the long term. And I know there's some intellectual debates about that between people, but the win-lose view or the lose-lose view is not a great one. And that changes quite a bit with SCF, because it can become a win-win. Maybe I have to pay later, but now you as the trading partner can take the funds sooner. Maybe you take them really early and pay a big discount. Maybe you take them on demand, but now you have more flexibility on a component and you don't just have to accept what exists. So it provides a good environment where if it's not win-win, it's at least win-neutral for many organizations.
Talking about win-win solutions, let's turn our focus a little bit towards leading practices for implementation. How do you choose a solution that is a win-win? Are there any pitfalls to avoid?
Yeah, so the analyst report has quite a bit of information on this, in terms of avoiding pitfalls. But I think, as background on that, in terms of what I'm going to say, that would be a little bit rude on a podcast. But these solutions, supply chain finance and cash conversion cycles, they have significant value, and the larger the value that they bring to the table is usually correlated with how many areas it touches in an organization and between organizations. So it has a broader impact. And so there's two things to think about, given that, two concepts to think about when we think about pitfalls to avoid, and how do we choose a solution that's win-win, and how do we implement it? How do we get people on board? If we can think about these things, this helps eliminate just reciting a list of items, but provides a framework for them. So the two concepts are process improvements and a comprehensive view. For process improvements, we have this idea that people should have an end-to-end view of a process and not a silo mindset. And I know I've said it before, and you've heard it. It's common. Anonymous came up with this quote, of course, as have others. It's been attributed to others as well, that if you optimize part of the process, you sub-optimize the whole. So the idea of let's optimize the entire process start to finish, and not just within our company, but between other trading partners. So when we think about process improvements, there's an efficiency aspect at play. And maybe I made things better for my group and I sent payments to someone else and they're digital, and they had no way of tracking what those payments were for. And so now I've broken their cash posting process because they don't know how to apply them. They either apply them incorrectly and we get mad at them, or they have to now manually break out, call or email and say, how do you apply this? And now my payable staff has to go and say, oh, I have to research it. I have to send them back information. I was paying for these 5 items. And so when we think about, we have to think about beyond, just our part of the process. We have to think up and downstream in our organizations, but also with the other organizations. So that's a, end-to-end view and not a silo mindset. So that's really about the broader process improvements encompass that. Yeah, the other concept had to do with comprehensive view. It isn't about we need efficiency, or we need controls, or we need access to more capital, or we need better visibility to what's going on. Just like we have an end-to-end view on a process, we need to have a comprehensive view on what we're trying to achieve. It's not efficiency or control or capital or XYZ. It is efficiency and control and capital. So optimizing all of these items needs to be part of the solution set we think about in terms of what we select, how we communicate it, how we implement it, and how we run it. And those are, if we think about those two things, most of the subordinate pitfalls or the secondary selection choice drivers are going to come out of those. Not all of them, but it certainly provides a good start. So the overall end-to-end view of the process and a comprehensive view of what you're getting out of it. The other pitfall to avoid, I'm just going to mention it without bringing up all the specifics, but in the area of you're selecting solution providers, someone may be a cash conversion cycle solution provider, or they're a supply chain finance solution provider. And just because someone has defined themselves as a supply chain financing solution provider doesn't mean that they're actually lending money for the receivables payable side of things. They may be making many, many other loans that aren't backed by the short-term nature of receivables and payables. And this has had a significant impact on a fairly large, well-known SCF provider, and that's having some impact. But that just slapping a name on doesn't mean that that's 100% of what their business is, or that there's been a challenge there. But those are some of the pitfalls. Those are some of the opportunities to make sure you can have good success in selecting providers who will help you grow the value of your organization and your liquidity.
That's very good advice. As we come to a close, do you have any final thoughts or recommendations to leave us with?
Sure, Meredith. I would simply say it's worth reading. If you're looking at any of these areas, you want to become more informed about what's going on, or you have a potential to acquire this type of technology, or you're in the middle of an implementation, go to strategictreasure.com/ARS, so Analyst Report Series, or just ARS, and you can download your free analyst report almost instantly today. So thank you so much, Meredith.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.